When you're nearing retirement, one of the biggest financial questions is, how much risk should you still be taking with your investments? Too much risk and a market downturn could derail your plans. Too little risk and inflation eats away at your savings. So, what's the right balance? How much risk should you take in retirement? Let's look at two extreme scenarios, 100% cash and 100% stocks, and why neither is ideal. The problem with 100% cash? Inflation. Let's say you retire today with $1 million. If you keep it all in cash, earning 1%, but inflation is at 3%, your money is actually losing purchasing power every year. The problem with 100% stocks? Volatility or market swings. If you had retired in 2008 with an all-stock portfolio, you could have seen a 50% drop in your investments, making it a very rough time to be pulling money out. So what's the middle ground? The key is finding a mix of stocks, bonds, and cash that keeps your money working while protecting against big swings. And it's important to note that if you've really thought this out, you're not mixing it up just to have a mix. There should be a strategy behind the why of how much cash you have, whether you use bonds and how you use them, and what sort of stock or equity investments you want to use in your portfolio. Balanced portfolios help smooth the ride. Let's say you have a mix of investments, some for growth, some for stability. If we don't know with certainty which types of investment will perform well year in and year out, then investing with a diversified approach can help us to spread the investment risk. Check out this interactive chart on the BlackRock site. It shows us different investment categories or asset classes. In the stacked view, we can see the best to worst performing categories from top to bottom over the past 10 years. If we click relative to zero and highlight the asset class, we get a visual of how things performed relative to 0% performance. Cash usually will be closest to zero. Now, as we scroll over the different categories, we can see where they were in the pack of investment categories each year. You'll note that US equities seem to be at or near the top often over the past decade. This highlights where this chart, though really cool in how it displays the info, does fall a little short. So check out this chart by MFS. Now, it's not interactive, but 20 years to look at, and it's kind of an eyesore. But if you look closely, you can see now that we have large cap, mid cap, small cap, growth, and value. These are all broken out separately. It's easy to say US equities outperform consistently, just invest in that. But US equities is a very broad category. Over 20 years, large cap growth as a category has been the best performing option 7 times. But then REITs, in other words, real estate investment, have been the chart topper 5 times. Commodities end up at the top occasionally and at or near the bottom frequently. This chart highlights how a diversified portfolio here, which MFS classifies as equal allocation to all of the categories, is relatively stable in the middle of the chart, give or take a 2015 here or a 2020 there. The takeaway? Invest with your level of comfort, have a strategy, and be diversified. You'll notice I didn't say anything specific about the right mix. Maybe you should be 20% cash and 80% stock. Or maybe you should be 40% intermediate term bond, 10% money market fund, 40% US equity, and 10% emerging markets. That's not a real allocation I'd suggest, but the point is that the right amount of risk depends on many factors: your time horizon, income needs, and personal comfort with market swings, volatility. A well-balanced portfolio lets you participate in growth without exposing you to unnecessary risks. But it doesn't offer guarantees. It doesn't protect you against loss. In theory, it simply offers some smoothing to the ride. Want to see what risk level makes sense for your retirement? Run the numbers with a financial planner before making big shifts in your portfolio. Balance is key. Plan wisely. If you found this helpful, hit subscribe and check out episode 11 of the Perfect Retirement Plan for more insights on these important retirement decisions.